Good afternoon, everyone. What a day that we have had here so far as part of the Chicago Financial Empowerment Summit. We have seen John Hope Bryant and Melissa Conyears-Ervin in a phenomenal keynote address. I could not recommend more highly that if you did not see it, that you look at the replay, which will be posted on the Chicago Treasurer's website, as well as on the Hoover homepage for the event today. We've also seen a master class on building credit, on home ownership, building wealth through home ownership, and around financial planning for small businesses. Right now, we're going to go in a different direction, and I am very proud to share our panelists here on investing in the stock market. And we still have, of course, our local Operation Hope coach, Natalie Lorente, on the line, but we also have experts from the field. So we have from Rapunzel Investments, Miles Gage, and we have from our great friend and partner, NASDAQ, Jill Malandrino. And so between our experts here, we're going to spend the next set of time working together on learning how to invest in the stock market and how to think about the stock market. And so with that said, I'll be turning it over to the experts here. And I believe we will be starting with Jill.
All right, Jason, thank you so much for that introduction, and thanks again for having myself and NASDAQ represented today. So by way of quick background, I'm the global market reporter for NASDAQ, having created and host a show called NASDAQ Trade Talks, which is our #1 social and digital show at NASDAQ, covering all things that touch the capital market space, whether we're thinking about market structure, traditional asset classes, digital assets, personal finance, financial literacy. ESG is another big part of our coverage, and of course, leveraging technology to build diversity and inclusion within the workforce. So we really cover the gamut of everything that touches the capital market space. And I thought today a great way to start is before we even get into savings and investing, and this is where Natalie, Miles, and I kind of all fit in here. And when we think about good financial practices, it always is going to come down to thinking tactically short-term and strategically for the long term. And we split it up into 3 different sections. The first one being budgeting, because you can't even think about basic savings or getting to investing unless you have that as part of your budget. And it's always kind of a tricky conversation to have because quite honestly, Americans are not that good when it comes to savings. We have significantly high debt levels. And even the number surprises me. This is as of March 2020. Of course, that has been on the rise as we're all working through COVID-19 together, but our debt levels total $14.3 trillion. Okay, that's with the T, $14.3 trillion collectively as a nation. We live with those debt levels. So the basics before we can even think about saving and then using those extra funds, we have to allocate that within our budget. So when tackling this from a parent's perspective and discussing it with your kids, it's especially challenging in today's day and age because it's different than when we were younger. And I know every generation says this, but when I would babysit or when I would work, my part-time hourly job, we used to get physical paychecks. We used to go and cash them at the bank and see that jar of money grow. It was something physical. It was tangible for us. It's more challenging in today's day and age, if you will, because everything is done on a point and click basis. You don't have the physicality of budgeting and saving and really understanding the value of that dollar because everything is just digitally assigned values at this point. So when you're talking about a budget, really all it is an estimation of your revenue. We'll call that your paycheck, and expenses. And and when you talk about expenses, that's a really hard part that people need to face themselves with. There's a number of differences with expenses with wants versus needs. And those needs would be housing, utilities, car payments, and so forth. Of course, wants is allocating to, let's say, your power budget, entertainment budget. And you also want to think about it over a specific future period of time, whether it's by weekly, monthly, annually, depending on your short-term and longer-term strategic and tactical goals. Now, to manage your monthly expenses and preparing for life's unpredictable events and being able to afford your big ticket items without going into debt, budgeting is important. It is the most key thing that you'll do once you start adulting. And you don't have to be good at math, and budgeting doesn't have to be a drag. If you're proactive about it and you're honest and realistic about what your after tax income looks like, and where you're realistically going to be able to to allocate those funds. Now, a great exercise, my brother-in-law is a high school teacher, and he actually does this exercise with his classes each year during the personal finance portion of the curriculum, where he'll actually lay out a budget um, based on, median income and state within which they live. Assume you have, the typical family, 2 kids, 2 partners, and budget that out. And it's really such an eye-opening exercise because what you think you can afford, and this is actually done before tax. They haven't gotten that far in the curriculum yet, but he has told me this is the most eye-opening exercise that they can do all year with the kids. And I think that's a really great exercise, not only for kids to understand how budgeting works, but I also think it's a good idea for caregivers, parents, guardians who work with their kids and give them that responsibility. So the question always is, how much should I budget to savings? And just like everything else, it's the dollar amount is always going to be relative, based on your income, based on your lifestyle, based on what you've established as wants and needs, where you decide you want to live geographically. That makes a big difference, and of course, that all lends to what you can comfortably afford. So again, it's more about the percentage basis than the actual dollar amount. Budgeting $100 is very different than budgeting $100,000. So there's an interesting formula. It was popularized by Senator Elizabeth Warren in in her recent book, and it's called the 50-30-20 rule. So it's something that's easy to remember. Again, this isn't complicated math. It doesn't have to be a drag. This certainly isn't rocket science, but it's a matter of being honest, realistic, and reflective of what you can tangibly afford. So 50% goes towards your needs, right? So that'll go towards housing, utilities, car payment, all the things that you need to pay in order to get through life. Your 30% would go to your wants. So if you want to allocate, that's going to be the budget that's allocated for vacation, for entertainment, when we can all be back together at sporting events and concerts and so forth. That's the want. And then the 20% from there, that's what goes into your savings. When we talk about savings, and Natalie and Miles will get more into this, it's not just necessarily your savings account at the bank. There's a number of other things, whether it's an IRA that you contribute to personally, whether it's a 401k or some other type of long-term savings plan through work. That's where that 20% number comes from. And another great feature that all banks and institutions have are you can automatically have that taken out of your paycheck or taken out from your checking account, your liquid money. So it doesn't, I don't even realize my 401k payments come out of my check. So there's so many ways that you can do it on an automated basis right now that really is key to being consistent about it, because it's an automatic feature built into your budgeting tactics. And there's a number of exercises, and again, I'll pass this presentation along. I know it's a little bit hard to conceptualize without me being able to screen share, but I created a page with some guidelines in terms of how to track your budget. So you're looking at your expenses and income, physically create those categories that fit your lifestyle, setting your short and long-term goals, because again, budgeting's not dollar amount. It's based on that 50-30-20 rule and short and long-term goals. And that's really where the key is. And I think once you understand that, that's the good jumping point. Cut certain areas to make those goals possible, right? Unless you have unlimited amounts of means, it's just not feasible to have everything that you want, or you have to think about your timeframes in terms of when you can achieve that. And the thing is that budgeting doesn't have to be set in stone. You can adjust your budget accordingly over time as your goals change. And I think when you approach it that way, from a short-term tactical point of view, to set up for your strategic long-term goals and being realistic about it, it's much easier to approach. Because the thing is with budgeting, like everything else, procrastinating and not facing it head on really is what can derail you from all of that. So the bottom line is here, before I pass it over to Natalie for the savings portion of it, there's 3 things I'd like everyone to walk away with. As I mentioned at the beginning, savings, it's difficult, and life throws surprises our way. But if you follow that 50-30-20 rule, it's a conscientious way to manage your after-tax income, and will keep you on track. There's a number of resources that I go to in the course of my financial literacy work, and people that have been on my show, and we team up together to bring this content. There's 3 that are my go-to. So I strongly encourage everyone to incorporate Investopedia. Another one is the balance. And the final one is NerdWallet. NerdWallet does a fantastic job with offering these kinds of resources. And even through your banks or online broker platforms and so forth. There's so much financial literacy and content that's available out there. This really is a great time for the retail investor, for the average person to access all of these tools and so forth. So with that, and again, I will send my presentation around. I'm going to turn it over to Natalie for our savings portion of the presentation.
Thank you so much, Jill, for those great guidelines and those pointers. I'm sure everyone's looking forward to read up on that and get more information. Let's see if I have better luck with presenting. Let's just give it a try. Okay, so my name is Natalie Laurenti, and I'm with Operation Hope as a credit money management coach, as well as a program manager for the youth empowerment side. So just to work in connection, some of you may be asking, well, is this an investment class or what? Well, the basics, we're getting down to the nitty gritty. We're giving you the very basics before you're even prepared or capable or ready to begin investing. You have to consider these things. The important topic that Jill just talked about is budgeting out your money. And now we're going to get into a little bit more about savings. So for savings, we're going to break it down to the very basics of needs versus wants, how you can earn, plan, and save, making proper goal setting, which also aligns with making investments, the types of savings accounts that are allowed, and how to incorporate your kids. Because nowadays with the COVID environment, how can we make it a family affair and get everyone involved? Great. So on to our first session, needs versus wants. Sometimes it can be really tricky, a process. This process requires that you be absolutely honest with yourself. And one of the best ways I've found in working with clients, or just even for my own personal finances, are identifying your needs by category. So what would be an example of needs? Let's see. So by definition, a need is something that's necessary for survival. And your needs would be categorized as mainly your set expenses, or your expenses as your mortgage, your rent, food, transportation, utilities, and insurance. Now, wants, on the other hand, are classified by those little things that just make life more enjoyable or more comfortable. You might not need that salted caramel latte in the drive-thru at Starbucks, but boy, it probably makes you happy when you're going to run errands. So examples of wants that can really catch up with you and hinder your progress towards making an investment or even towards your financial goals are those sneaky little eating out, spending on clothing or entertainment that you might not notice. I had one client just this past month who was spending over $100 on online subscriptions. And she didn't realize at the time that all of those subscriptions added up to be that much. She was thinking, oh, it's just $5 here, $12 there. But you'd be surprised as to how much eating out and entertainment and even subscriptions can add up. So you have to keep your eyes open or track your expenses. Excellent. So let's see. So now we're on to the next concept: earning, planning, and saving. So it's important to show, to involve your children or just your family members, to show the relationship with work and money, to kind of get even your younger kids into the mode of how the budget works. When you're out at the grocery store, showing them like the value of money, like this product, this one is Oreos are our favorite, but if you buy the knockoff brand, they're $1 less. So showing them the correlation between the value of the product and the differences or the quality that you can receive, as well as, mom and dad, we go to work, and that's how we're bringing in the money. Like share with them your budget, A, show them the correlation between work and money, and B, show them the differences just when you're out doing shopping. Planning is my favorite part. So by sharing the budget with the family as a whole, you get everyone on task. I've had a lot of couples who have come to me for credit coaching, credit counseling, that they think they know where their finances stand, but there's a lack of communication between the two on what's being covered by what, or what money is going out. So it's always a sound practice to share and communicate those things with your family members. Finally, it's always, even for us as adults, we're in a world or in a realm where you can click and you can have what you want. Well, there was a thing back in the day that's called like delayed gratification, where you can't always just buy or have what you want at your fingertips. So even for the everyday common person, yeah, you might want to splurge on that new iPhone, but in the long run, in 2 to 3 months from now, is that going to put you in a bind? Can you truly afford it if you're tacking on an extra $50 to your phone bill? Or is that going to leave you in a lurch when you need to buy extra groceries or an emergency comes up? As a rule of thumb, you should have at least 3 months worth of monthly expenses saved in order to begin investing, or even just to be financially sound in your own financial wealth house. So if you want something, the key to that, if you want something, you got to save up for it, or you really have to think about the long-term effects that that purchase would have on you. All right, so how do we set money goals? I'm sure everyone loves the SMART goals. SMART goals are specific, measurable, attainable, relevant, and time-bound. So the same holds true for money goals, or just goals in particular. Now is an excellent time, especially during COVID, either if you're not too busy with work, or you're just trying to get together, hey, I want to get my money in order for next year, and then I'm going to lose 10 pounds. Whatever your goal is for next year, now is an excellent time to begin thinking of those. So the first step in doing that is identifying your goal. It can be as simple as, hey, I want to get my credit score up 50 points. Or, hey, you know what? I didn't qualify for that SBA loan for a small business. I need to work on something. Or, you know, we're planning on purchasing a new car or a new home for next year. So how much do I need to set aside? Or what is the general rule? So that's the next part in setting any financial goal or any money goal, is determining how much you will need. So this also correlates with your investing goals, because you have to identify, okay, how much can I allocate towards investing? How much am I ready to part with 200, or do I have 2,000 to just to just get going on this? Another rule of thumb in saving is always to pay yourself first. What I like to do is, before I even see my paycheck, I have 5% going to a savings account so that it's untouched, because it can be really tempting, especially when you're out shopping or even online shopping, to at the click of a button. Remember that delayed gratification, right? So always pay yourself first in case of a rainy day. And then you can do like I did, or how many others do, setting up an ACH, or an automatic clearinghouse payment that will go directly into your savings, so you just don't really think about it. Sometimes when it's automated, it helps you to take the guesswork out of it and not to spend that money. Yeah. And one of the things that I mentioned before, you have to watch your spending. Definitely, just like Jill had highlighted for us, keeping hold of your budget, or getting your budget realigned with what your financial goals are, your money goals are for this year, is important. And then just watching what you're spending and those subscriptions, how they can creep up on you. Excellent. Types of savings account. Okay, down to the nitty gritty. So there are different forms or modes of savings that you can utilize. The traditional mode would be via savings account at a bank, any bank. There's Fifth Third, there's US Bank, there's quite a few. Generally, there are unlimited withdrawals. Here are some of the pros to that. And there can be low minimum balance requirements. Say if you want to get your kids involved with decision making or money matters, depending their age group, and you wanted to set up a savings account, that's probably one of the best ways to go, other than the piggy bank method. But savings account generally have low to no fees. I think you're allotted up to 6, well, if in the event of emergency, you're allotted up to 6 withdrawals, I think in a quarter. Don't quote me on that. The only con to that is that it doesn't generate the same type of interest or compound interest that it would with something a little bit riskier. So the definite pro of having accounts within a bank, or utilizing any of these, we can talk about these other two, is that the safety of it. So it's backed by FDIC insurance. If in the event anything were to happen, or the bank were to close its doors tomorrow, it's federally backed by the government, that you'll receive your money in hand. Another, so that's one of the advantages, is to have your money guaranteed up to I think it's 100 or 200,000 now. Sorry, I've been out of the banking world for a little bit, but it is guaranteed by the government. Anyhow, so these other two that are also good modes, or what some people used to do years ago when the rates were a little bit higher, is they used to use certificate of deposit as a way to earn compound interest. So for example, if you decided to go the safe route with the certificate of deposit, there could potentially be a lot higher interest rate, especially if you have an established relationship with the bank. Yes, banks do have their stated interest rates, but if you're a long-time customer of the bank, a long-standing customer or established, I can bet you money they might be able to negotiate a certificate of deposit rate, depending on your relationship with the bank. So it doesn't hurt to try that. The only downfall for the certificate of deposit is that you do have penalties if in the event you needed liquidity in your money, or there was, say, an emergency. There would be a penalty for an early withdrawal if you were to take it out prior to its expiration date. Okay. One thing, since we're talking a little bit about generational wealth and how to protect yourself and how to make your financial wealth house stronger before delving into investments, the one thing that I really like for parents to understand, even if your kids are a little bit older, it's not too late. There's something that's called a 529 plan, which is directed towards the college savings of kids. And some of the things that are beneficial is that anyone can contribute to this plan. It doesn't have to just be you. There are actual tax breaks that you can write off at the end of the year. You can always change beneficiaries, and there are flexible plans that apply to both state and private colleges. One of the fun facts is it can be even used for like trade schools, culinary schools, and things of that sort. So it locks in your tuition rate for your chosen university, and it's pretty much it's considered prepaid tuition. And it's a very good form of utilizing for kids or for your financial planning as parents for your children's college education. Excellent. So we're going to talk a little bit about incorporating your family or teaching kids to save before we move on to the investing part with Miles. And I just wanted to go over these really great pointers for parents. You can incorporate your child at any age that they are. For example, if your child is 3 to 5 years old, you can start talking to them a little bit about money decisions. You can have your own child set aside a goal. For the older kids, it might be a PS4, but for the younger kids, there might be that one toy that every time you go to the store, they're always eyeing it, right? And you're like, well, remember that delayed gratification. We can't always have what we want right now. We need to use our budget. So by having them write down or having them see, well, this toy costs $50, and we can put a little bit at a time into your piggy bank at home, or, we can make a $5 contribution to your savings account. And then if you're going to do it physically, kind of the old-fashioned form, it's a really cool idea to have your kids count down the money each time they make a deposit, or show them the growth. So it's reflected in their balance if you're doing it online. Some of the other tips for the older kids, for example, are creating savings jars. Hey, this works for parents too. This works for adults. Allocate your funds according to your goals. So for example, if you have an educational goal, or if you have, say you needed a new laptop or new equipment, you can allocate those funds towards your actual goal without having to dip into your biweekly or payroll, the payroll that you receive every 2 weeks. So without having to use your liquid income, your money that's usually going towards bills, but actually saying, hey, okay, so yeah, I could get that right now, but then that's going to set me back $150 or $200, and I'm going to have to come up with money some other kind of way. Instead of doing that, it's much better to hold off and allocate money towards whatever your goal might be. Hey, maybe it's vacation once we come out of COVID. I want to travel to Europe or do this. whatever the thing is that you're trying to accomplish, even with your young children, you can incorporate the 3 ideas of saving, spending, and sharing. So saving, that's a given. Spending is, hey, if you, a little side money, if we want to grab pizza or do something, or how about giving back to the community, sharing with others. That's also a good idea to incorporate community and teach children. Assist them in making their choices on how to divide their money. And for your own personal self, also keep those three buckets in mind. If you start with those, by creating those 3 jars or those 3 objectives, you'll be in a much better financial state to either invest or just be better positioned in case of an emergency. So the last 2 here we have from 11 to 13 years old. You can also shift the idea of saving for short-term to long-term goals. And this also applies to ourselves. I mean, if you have a long-term goal of purchasing a property and using that as a form of investment, or if you have a long-term goal of, boosting your retirement savings, you should have, as an adult, your short-term financial goals as well as your long-term financial goals. And then from ages 14 and 18, we want to get them thinking about compound interest, especially as it relates to certificates of deposit. That's a great, here's a great example. If you have your child set aside $100 every year from starting at the age of 14, you would have $23,000 by the age of 65. So if you can get them in some kind of practice, or even in yourself, if you can discipline yourself to set aside a set dollar amount, even if it's $50, I don't care what it is. But the sooner you start saving, the more you have over time. You see here in the correlation how it states, well, if you start at 35, you'll only have 7,000 by 65. So by having your kids and your family a part of the discussion, and especially giving your kids the opportunity to grasp hold of the basics of money management, it will empower them to make sound decisions, and it also empower yourself to set those financial goals and be in a strong position to make investments or to have longevity when it comes to your retirement accounts, to have something to fall back on. So always use buckets for multiple purposes, or have those different savings goals. All right. So next up will be investing, and I will turn it over to Miles to share on that portion. Thank you. Miles, take it away.
All right. Well, thank you for that introduction. My name is Miles Gage, and I am the co-founder and CMO of Rapunzel Investments. Rapunzel itself is a simulated trading app that allows individuals to interact and engage with the stock market, in the sense that we give each user 10,000 fictional dollars to buy and sell publicly traded companies. So that way you can see what your returns or losses would have been had you actually executed those trades with real money. And for people that are listening, I'm typing that in the chat, and that's Rapunzel without an E. But essentially, we utilize the platform to host investment competitions for high school and college students with real scholarship prizes. And in fact, we're actually launching a spring competition that goes live January 4th and will conclude in the end of April. And we have $4,500 in scholarship prizes. Additionally, if you go to RapunzelInvestments.com, you can find out more information about these scholarship prizes that we host on the platform. And so how I even got into the world of investing, it's really a culmination of what the previous 2 hosts were just discussing. When I was younger, my mom made my brother and I split our money up 3 ways, the 3-jar system. So 50% of my money would be my savings. 50% of my money would be spending. So that's what I would have to live and buy, like my discretionary items. My 40% of my money would be split up and go into savings. And then 10% would go to charity, because regardless of what you get, you always have to give back. But moral of the story is that 40% savings jar ultimately ended up becoming my investment jar. So when I was 12 years old in 6th grade, I actually joined a teen investment club, Ujama Junior, where I started managing my own portfolio of stocks. And so that money that savings money that I had been saving from various chores, various birthdays, in Christmas, etc., that allowed me to start buying real stock in the market. So I think I actually started with $200, and the first stocks I bought was like a share of Apple and a share of Nike, and I kind of kept going with that ever since. And in fact, I actually wrote an essay hosted by the Federal Reserve Bank of Chicago in 2008 about how I plan to finance my college tuition, with my main point being liquidating my stock portfolio. So they weren't expecting a 14-year-old, let alone 14-year-old from the South Side of Chicago, to be talking about their stock portfolio. But nonetheless, at this age, this was 14. So this was in 2008 at the time. So we all remember that this was in the midst of the global recession due to the housing market, which sent ripple effects into other industries beyond housing markets. So you saw the stock market decline as a whole. But me as a 14-year-old and understanding market cycles, i.e., there are times when the economy is growing and stock prices are rising, and understand that there are periods of contraction when the economy is declining and stock prices are dropping, I saw that we were in a period of decline. And so I was able to buy a lot of stock in a lot of companies that had discounted stock prices due to the overall macro economy. And at the time, as the saying goes, buy low, sell high, I was able to get those stocks at a bargain as a 14-year-old, and I've since held on to them and have witnessed over 1,000% returns in my stock portfolio. And so due to this early involvement in the stock market, I would often go on speaking engagements in the city of Chicago and around in this region, talking and promoting the importance of teens investing. And so in 2016, upon graduating from U of I in Champaign, my friend, my high school friend, and I from the lab school in Hyde Park, we decided to create an app because while I can go speak, I can only impact such a finite number of people. But I know that if we develop an app that allows people to engage with the stock market, that can have a massive impact. And especially looking around at our friends that attended elite schools but don't know about the stock market, we knew that this was a mainstream issue as well. And basically, a lot of people would always ask me, like, how do I invest in the stock market? What do I do? And so we created an app that allows you to do that. So essentially, Rapunzel, like I said, every user gets 10,000 fictional dollars, and then you can buy and sell publicly traded companies. So you may be wondering, all right, well, I've downloaded this app. What are companies that I should be looking at? And so an acronym that I mentioned to any novice or anybody just getting in the market is FETCH. And that stands for 5 core industries that are needed regardless of how the economy is doing, regardless if we're in a pandemic, regardless if, unemployment's at 0% and everybody's wealthy. These are companies that are fundamental. So that acronym is FETCH, and it stands for financial services. And I'm typing that in the chat as we speak. Energy, technology, communications, and healthcare. So I'll just break that down. So let's think about it. Financial services. These are the banks like the JP Morgan Chases, the BMO Harris's, Bank of America. You probably all have bank accounts. So regardless of how the economy is doing, people will still refer to their banks and will still utilize banks. So that's an industry that's always going to be needed. The next one is energy, because I'm sure most people on this call may have a vehicle that takes them from one place to another. So they need gas. So people are always going to need gas. Or if we're really on that environmentally conscious wave, then we're all going to get electric vehicles. So that's another facet of that. T stands for technology, because I'm sure just like you have your smartphone in your hand. And when was the last time you went a day without utilizing some type of device? That's something that's here, and it's not going anywhere anytime soon. And also, the C is communications, because we all need to communicate with each other. So like the Verizons, AT&Ts, and Sprints of the world, those are like core companies that are leaders in that space. And then H is healthcare, because why are we on a virtual call right now? Because of a global health crisis that's going on. So as we know, there's a scramble for a vaccine. So as we're seeing now that there's kind of like a sudden interest in a lot of pharmaceutical companies that are creating supplies that are either directly combating or providing ancillary support to the COVID-19 virus. So that's like something that those are things that are always going to be needed. And if it's not COVID, it's something else. So these are things to think about when you're initially investing. But I would encourage everyone to download Rapunzel. Rapunzel is in the iOS App Store, and then it's also in the Google Play Store. And then for people that are searching, it's Rapunzel without the E. And so, yeah, that's kind of Rapunzel in a nutshell. And just to share with you all some initiatives that we're working on. As I mentioned, we have this essay competition available for high school students and students that are currently attending city colleges. So if you know anyone or have anyone in your network that would be interested, please share that with them. So it's Rapunzel, RapunzelInvestments.com. And the acronym is Fetch Financial Services, Energy, Technology, Communications, and healthcare. And so when you download the app, it takes you to a home screen, and then in the top right hand corner there's a magnifying glass. So that allows you to search by either the exact company's name or by industry. So that way, these industries that I just mentioned in the chat room for all, because I had to redo that. My bad, guys. You can search for companies within those spaces, and then I would encourage you and young people in your life to just begin building a portfolio and just testing the waters out. But when you're ready to invest, and I encourage everyone to invest, because it's not about timing the market, it's about time spent in the market. That once you're ready to put actual money up, I personally use Charles Schwab, but like Fidelity is another great platform that makes trading very easy and at its fingertips. So I'm currently looking to see if there like anybody has any questions for me, please type them below. But as I was mentioning, we have the high school competition, and another thing that's new for us this year is we formalized our nonprofit, which is called the Destiny Project. And essentially what the Destiny Project is, it's a pipeline for high school seniors and city college students to engage with careers and individuals that are in financial services, because there's currently really not a pipeline for Black and Brown students to immerse themselves in this space. So what we're doing is we're taking 12 students this year, and then we're putting them through a 12-week program that emphasizes the soft and hard skills needed to have success in corporate America, and pairing students with mentors, and then also having lunch and learn series where we'll have individuals from various companies come and talk about what they do and some of their different career tips. And so that information about the Destiny Scholars Program is also on the Rapunzel site, and that's an essay. And now that prompt will be going live January 4th, 2021. And then we'll be selecting winners to participate in the Destiny Scholars Program sometime in April. And each student that participate in the program will be given a $1,500 stipend. But we saw that some of our work in Chicago, we host investment competitions since 2018. We've seen how much of an impact this has had in Black and Brown communities on the South and West sides, and with kids that have never interacted with the stock market, and them seeing this as a vehicle to build and accumulate wealth and overcome their family circumstances. But now we really want to take that a step forward and showing them routes into how they can really have success by not only participating in the stock market, but also potentially getting in a career path that allows them to have jobs within this field as well. And the range for the Destiny Project, again, the competition, the investment competition is open for all high school students, and we have $4,500 in prizes. The first prize winner gets $2,000. in scholarships. Second place prize is $1,500. I'm sorry, first place is $2,500. Second place prize is $1,500, and then the third place prize is $1,000. And so anyone in high school is eligible for that. But then, as far as the Destiny Scholars Program, that is specifically geared towards current high school seniors that will be graduating in June and students that attend city colleges. Are there social media platforms where we can learn about it? You can search us on Instagram at Rapunzel Invest. You can reach me at, and I'm typing my email. And so if you have any questions, you can feel free to reach out to me directly as it pertains to either my personal story or just utilizing the Rapunzel platform. But I think as far as engaging with financial markets, it makes sense to like start reading like Wall Street Journal, Bloomberg, Investopedia is a great one. Even the Rapunzel platform, we have a lot of educational content in the platform that has a lot of frequently asked questions for beginners, and we have some video content within the app itself to also further assist individuals that or have questions about investing. So I thank you everyone for listening to my presentation. So that's all I have. So thank you.
Thank you, Miles, for leading the conversation. If anyone should have questions that you have for either myself, Miles, or Jill, I think there was one question in the chat. How do you determine if a stock is being sold at a discounted price? Miles or Jill, I'll defer to you guys.
Yeah. So how do you refer if a stock is trading at a discounted price? I would say that you want to look at the financial metrics. And so I would say start reading a company's annual report, which can be found on a company's website. And so that basically tells you the company's performance from past, present, and the future. And so that way you can get a good snapshot about how a company is performing. And in addition to that, you can see how it's reflected in the stock price. And so while a company itself may not necessarily be that in great shape, its stock price may not reflect that. For example, like I had a lot of people reaching out to me about like, oh, am I going to buy Airbnb stock today that just went public? I would say no, because I don't think Airbnb is profitable right now. And it's definitely taking a hit due to the travel industry being on a downtrend right now. However, given that it's a new stock, I think that the stock price will probably go up today. Just on hype alone, but inherently, I don't think the company is that great at the moment. But another indicator that you can see if a company is expensive or not is by the PE ratio, and that stands for the price of the stock price divided by its earnings per share. So it basically tells you how much you're paying over a dollar in earnings a company receives. And so the higher PE ratio is, the more expensive a company is perceived to be. And the lower the PE ratio is, the more of a bargain it can be perceived to be. However, it's important to note that PE ratios vary from industry. So technology companies, for example, tend to on average have higher PE ratios than banks that typically have lower PE ratios. So those are things to think about. But within those industries themselves, the higher the P ratio is within the tech space, that still means that that company is deemed to be more expensive amongst its competitors. Just like the banking stocks, while they historically have lower P ratios, the higher the P ratio for companies that are in the financial services, the more expensive that they are perceived to be, or the lower that they are, the more of a bargain they're perceived to be. So that's kind of like a high level answer. But I think that the true value or the true way to do that is by like researching more of the company's fundamentals and looking at if the earnings support and if earnings are consistent. Because if earnings are either historically declining or historically staying the same, and then we look at the stock price movement over the same period in time, if the stock price is basically outpacing the growth that the company is really experiencing inherently, then that company is overvalued. So that's one way to think about it.
Hey, Miles, it's Jill. I want to follow up on what you said. So basically what Miles is talking about is valuation. And there are two very distinct things that you need to understand. When we think about stocks, a lot of times we will intertwine the words cheap, expensive, highly valued, undervalued, and so forth. When you think about, a lot of times people will think that, okay, so Amazon is a multi-$1,000 stock, right? And that might be considered expensive. From a capital perspective, it could be expensive if that's not a stock you could afford. Now, as Miles was saying, again, depending on what sector you're in and how stocks are valued, and it's not only just PE ratio, there's a number of other metrics, and different sectors have different valuations. For example, financials are, based on book value versus PE. So there's a whole number of fundamental tactics that go into it. But I think when you're analyzing a stock, it's important to understand that valuation and the price of a stock are two very, very different things. Another thing I want to point out as well, Apple and Tesla had stock splits over the summer, which is quite rare for technology stocks to split their stock. And of course, we saw a lot of money flow into that because, it's easier to afford a lower price stock versus when they were trading at much higher levels. That said, it doesn't mean that the valuation has changed, right? So if you have a $100 stock, split that 10 ways, $10 bills are still $100. $1 bill, 100 of them is $100. So the valuation hasn't changed. It's just the price of the stocks. There's a lot of terms like that you should be familiar with. But somebody asked a great question in the chat that picking individual stocks, especially if you're starting out, can be very tricky a lot of times. And this is a phenomenon that we saw in 2020 as a result of COVID-19. The level of retail activity skyrocketed. And a lot of the stocks that we might hear about more frequently might not have been moving on fundamentals, but more on the momentum of so much retail activity coming in. And I think that's something that's going to be here for a while, especially if the market continues on its trajectory. So that said, I think when you are a newer investor, as you're learning how the machinations of the stock market work, that perhaps looking at an index fund or a mutual fund, or something that's more common today and probably one of the largest growing asset classes are ETFs, electronic traded funds. And what this is it's a basket of stocks. And with an ETF, you can trade in and out of it like you would a stock at any time during the day, before or after market hours. Whereas a mutual fund, you can't. You can only, it's a once a day kind of thing. ETFs are great because you can either buy the SPY, right, which is the S&P 500 ETF. It tracks the S&P 500 index. We have the NASDAQ 100, QQQ, which has had a spectacular year, of course, with technology stocks doing so well. But if you, let's say you want to own the NASDAQ 100 stocks like Microsoft, Apple, Amazon, Tesla, Zoom, all the things that we use in what we call the modern day industrials, our new economy, that's one way to get exposure to it. Because from a capital perspective, you're not going to be able to efficiently track the index, nor would you have the capital to do so. But you can use ETFs to either track a specific index. Another one that did really well, in fact, it was one of the best performing indexes, ETFs this year, were cloud-based ETFs. WisdomTree has one, WCLD. And because all of the technology that we're utilizing right now, with the ability to pivot and work from home, all based on cloud technology. So you can also get very thematic with ETFs, whether you want to look at a specific sector, subsector, track an index, a theme. There's a lot of ESG ETFs out there. There's one that's called UFO, which is a favorite of mine, that looks at all the new technology related to space investment and so forth. So if you're concerned about getting in individual names, or a sector might be too risky for you and so forth, using these package products is a great way to dip your toe in.
Right.
Yes, I'll type in some ETFs.
And we have some follow-up questions. One that has been waiting is, can you explain option trading, calls and puts? And what are some of the best index funds?
So I'm putting in a number of ETFs that track indexes. You don't invest in the index specifically. So that's a distinction I want to make, right? These ETFs they track the indexes. So that's going to be a more efficient way for newer retail investors to get involved within those specific indexes or sectors. Now, options is I think that's a webinar for another time. Options are basically derivatives off of stocks. It's a contract for the right to buy or sell said stock at a specific price. Options are also used to hedge long portfolios, as an example. So if you've had a run up in your, let's say you have a lot of technology stocks, you can buy options on the QQQ or on the index itself to protect those gains. Again, that is a very different conversation than what we're having right now. But the simple short answer is options are derivatives off of stocks. When you trade options, you don't have ownership in the company like you do with a stock. It's a derivative of it to either hedge or speculate on your position.
Thank you, Jill. And just one thing, like to address Kyle's question. Yes, passive investing is definitely is a great approach, but I think it's one thing to see the movement firsthand. That is something that's very captivating to the young people, especially while using a simulating platform. Because even if they lose money, the movement is much exciting, and then they go and do their homework and research, versus you're not really going to captivate the attention of a 17-year-old or an 18-year-old from the South or West Side if you just tell them like an index fund, because it's just not cool, unfortunately. And while we know passive investing in the long run is the way you truly is way you truly make money, this is just a way to expose young people and to get them even excited about financial markets in the first place. And that's one of the things that we often end with when students are utilizing our platform. And it's great that you had this performance over a shorter duration of time. However, you're probably going to want to pick a basket of companies. And if you don't have the time to do all the individual research, then it is best to pick an index that provides you a variety and allows you to take basically an average and generate those returns instead. So those are just like some things that I would like to leave off on. But thank you all for the questions.
And allow me to begin to wrap up the section here, as we will be jumping into our last session, which is actually 2 breakouts in just a moment. But what I'd ask is that our 3 panelists here give us their quick 30-second advice of, if you are hoping to begin investing in the stock market, what's the first and most important piece of advice that you'd like to give somebody that they should consider? And we'll start with Jill.
Education, 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 and more education. It is critically important that you educate yourself about the market and about the process that's involved. I started off in equity trading in 1998, and having worked on a professional institutional trading desk and on the floor of the New York Stock Exchange, now working for NASDAQ, the tools that are available to retail investors are far superior to anything that we had on the institutional level 20 something years ago. So this is a fantastic time for retail traders to get involved. I strongly encourage you to take advantage and leverage all the education assets that are available, whether you start and you open an account with Fidelity. That's where I have a couple of my personal accounts. TD Ameritrade is another platform that I like a lot. Rapunzel, of course, is a fantastic place to start. It's called paper trading if you don't want to commit resources but understand how the market and stocks work. I strongly, highly recommend going to Miles' app. Again, Rapunzel. That is a great way to get started. And someone's asking, when you say education, my go-to is always Investopedia. Just go on Investopedia, and every single topic you want to know is there. I'll type that in.
Thank you, Jill. Natalie, what would be your first important piece of advice?
My first important piece of advice would to be make sure that your own financial wheelhouse is secured. What does that mean? That means having at least 3 to 6 months of monthly expenses saved in the bank before you delve into investing, as well as setting those financial goals for yourself and for your family for the coming years.
Excellent. And Miles, what would be your first big piece of advice for somebody looking to get into investing for the first time?
I would say have a thesis, and that means really have conviction why you want to buy the stock. Don't just buy it because you heard about it or your friend told you about it or it's hype. Really understand the fundamentals of the company and its business and leadership, and that itself is the reason why you should purchase the company. And then I would say that once that thesis changed, and that's when you would ultimately sell. But you have to have a real reason to really support it. And I would say that's the biggest thing.
Excellent. So thank you again for joining this session, and we'll be seeing you in about 60 seconds on the next breakout. Thanks.